10-year note yields moved higher. Recall yesterday they got to 440 for the first time since Thanksgiving. Today extended that move north of 440 all the way to 442 before pulling back in the afternoon and closing near unchanged at 435. Now, early in the session, we got stronger than expected ADP data. Likewise, we also got some very hawkish comments from Atlanta Federal Reserve Bank President Bostic, who said that he thought maybe the Fed should be waiting until fourth quarter before cutting, if cutting at all. On that news, we saw yields move higher. However, in the later morning, early afternoon, we absorbed comments from the Fed chair himself, where he spoke, kind of pulling back the reins a little bit on some of the Bostic comments, being a little bit more moderate, talking about the need to wait and watch and leaving all rate cut possibilities on the table, saying that he didn't think that the situation had materially changed the picture all that much, likely alluding to the higher inflation data that we got last month, but ultimately seeing 10-year note yields close near unchanged at 435. Now, what does this mean for volatility? Well, check out that CVOL index over at cmegroup.com. You will see that today volatility got bid early in the session after we saw the stronger ADP data, after we got hawkish comments from Mr. Bostic, and after yields rose. However, after Powell spoke and sort of calmed the market and brought yields back down to unchanged, volatility didn't come down as it typically has historically. Volatility remained elevated, likely given the fact that we're seeing a shift in odds for potential rate cuts down the road, as well as upcoming key data points. But again, volatility moved higher early in the session, remained higher on the day. Last, let's talk about what we have tomorrow. Tomorrow is Thursday. To get our in-the-moment look at the job market via the claims numbers. We also get a slew of Fed speakers likely to continue to talk about expectations for Fed rate cuts. And then the market, as it is always forward-looking, will be looking ahead to Friday's non-farm payroll number, which last month saw a strong 275,000 new jobs. This month, expecting slightly lower at about 215,000 new jobs. So midweek, we see yields continuing to push higher today, getting all the way up to 442, the highest since November, before pulling back to 435 ahead of tomorrow's claims, a bunch of Fed speakers, and Friday's non-farm payroll.